Welcome back to this week's market update. Today is Tuesday, January 20th, 2026, and we'll jump right in. Looking at last week's market performance, stocks finished the week slightly lower as markets weighed geopolitical tensions against stable economic data and early bank earnings. The Nasdaq Composite was down at 0.66%, followed by the S&P, which was down 0.38%, and the Dow down a slightly lower 0.29% last week. Now, looking ahead to this week, Tuesday morning trading showed some continued caution, reflecting concerns over U.S. Greenland tensions, as well as the potential for some new tariffs on European imports, keeping markets focused on near-term risk. You can see the major indexes were down, actually down a bit more earlier this morning, but still down about 1% across the board as of 10:30 Eastern this morning. We'll have to watch and see how this volatility plays out into the week, or if it's kind of contained into the early morning trading hours. Shifting gears into our economic data from last week, December's inflationary data came in largely in line with expectations, with headline CPI holding steady at just over 2.7% and core inflation at 2.6%. On a monthly basis, prices were up 0.3% on the headline CPI and 0.2% on the core CPI, reflecting continued progress towards disinflation, but at a more measured pace. By category, we saw grocery prices up a pretty high 0.7% in the month of December. Some of this may be seasonal, although some of it may be some hotspots of inflation kind of creeping up. Although when you look on an annual basis, it's only up 2.4%, so a much more moderate rate there. Energy prices were up 2.3% from a year ago. However, when you see the breakdown of it, utilities got a lot of inflation in the month of December. So energy services overall up 7.7% in the year, broken down by a 6.7% inflation rate in electricity and a 10.8% inflation rate in gas service. Looking at several other categories here, you can see new and used vehicles both saw pretty moderate inflation rates below 2%. Good sign there. Those haven't really been sources of inflation. And then last but not least, shelter inflation was down to 3.2%, which is a very moderate rate. It's been slowly creeping lower and lower, but it is the biggest piece of the CPI pie, so very important that we see disinflation in this category. We also got the November PPI, the Producer Price Index, otherwise known as wholesale inflation. It showed inflation creeped up a bit to an annual rate of 3%, headline, and 3.5% core when you exclude food, energy, and trade. By category, inflation pressures were concentrated in energy. You can see that was up 4.6% in 1 month, as well as transportation and warehousing and other services, driving that increase in the month. Trade services saw modest deflation, down at 0.8% in the month, while wholesale food prices were flat in the month, helping to contain overall inflation. Although we did see a slight rise in wholesale inflation in November, much of the increase came from categories like energy that are very volatile, suggesting that the rise in wholesale inflation could hopefully be pretty short-lived. Also last week, November retail sales data came in slightly above expectations, rising 0.6% in the month to 735.9 billion as the holiday shopping season began. This was largely led by a strong month of auto sales, you can see which were up about 1% in the month. And then on an annual basis, retail sales were up 3.6%, with non-store retailers, which includes online shopping, up 7.2% from a year ago, and dining out up almost 5% from a year ago. So on top of the resilience in those retail sales in that consumer spending numbers that we got last week, we also had some pretty resilient bank earnings with all 4 of the largest U.S. banks reporting. JP Morgan, Bank of America, and Citigroup all beat expectations, posting strong results in the fourth quarter. Wells Fargo fell short of analyst expectations. However, this was largely due to higher than expected severance costs, which should help their profitability in the coming quarters as they slim down their staffs and focus on efficiency. Following the earnings releases, though, we did get some selling pressure in bank stocks last week. You can see Wells Fargo with the earnings miss down almost 8%, the other bank stocks down also. Part of this was also due to a new discussion about capping credit card interest rates at 10%, a policy that would significantly hurt banks as most credit cards charge 20, 25, 30% interest rates, and so this would bring down a lot of their interest income on these products. Overall, though, I would say bank earnings looked pretty resilient. They are a very important barometer of the overall US economy, so these being in a pretty solid spot last week was a good indicator. Last but not least, home sales picked up in December, with existing home sales volumes rising at 5.1% in the month, up 1.4% from a year ago. This led inventory 18.1% lower, also lower due to the holiday month. However, we did see inventory creep up 3.5% from a year ago. This led to the supply rising to 3.3 months of supply, up from last year's 3.2, but down from November. And then the median sales price rose 0.4%, a very, very modest inflation rate there, to 405,400. Overall, the data reflected a trend of rising inventory, modest disinflation, and sales volumes that remain relatively subdued to the post-pandemic housing boom. So that concludes this week's market update. It was a very, very busy week for economic data, and we look forward to the week ahead. We thank you so much for tuning in, and we look forward to seeing you again soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.